During this year, crypto has already lost more than $1 trillion off of its market cap, and one of the reasons why we have been spiraling down this year is because of the collapse of one of the massive crypto projects, Terra Luna, which was originally created by Terraform Labs. But you could be wondering, why would a single project affect the whole market? Well, let us take a look at how massive this project truly was. First, Terra Luna was a coin featured in the top 10 with a market cap that has reached over $40 billion. Terra Luna was the second biggest project in the DeFi space, just right after Ethereum. Terra Luna was a project who had financial backing from the biggest names of the crypto space, like Galaxy Digital, which has invested $25 million in Luna. VC Chiron is another crypto investor who raised $50 million in investment in the Terra ecosystem. Those are just a few of the many examples, but if we're talking numbers, then in total, the Luna Foundation Guard, which is the body that governs the Terra Luna project, has ended up raising over $3 billion. So Terra Luna wasn't just yet another crypto project. And it wasn't a typical stablecoin. Terra Luna was big. And it was so big to the point that the people who support the Luna project, otherwise known as lunatics, took out loans and in some cases have borrowed hundreds of thousands of dollars to invest in Terra Luna. Just take as an example Mike Novogratz, a billionaire who was such a hardcore Luna fan that he ended up tattooing the Terra Luna project on his shoulder. No one wants to be in his shoes after that crash. And if you weren't a Terra Luna fan, you might be wondering, why did people go nuts about the Terra Luna project and put their life savings and tattoo themselves for something so risky and volatile as crypto? Well, Terra Luna had something called the Anchor Protocol, and this protocol had promised a 20% annual return on staking or depositing your coins in the project per year. And let's be clear, 20% is a crazy and extremely lucrative amount. To put this into perspective, the stock market, for instance, would give investors on a good year around 7%, so the third amount of what Terra Luna promises. Dividend investors, on the other hand, would get you 4% returns per year, and it isn't even guaranteed. So that 20% was a huge amount, which led people to do just about anything to invest in that stablecoin. And as a stablecoin, it was originally meant to hold its value and be actually stable, so that 20% seemed almost like a guarantee. But unfortunately, as we all know, this isn't what happened. Terra Luna collapsed, and people lost 99.99% of their money. Recently, Terra Luna was back with a new version, which is Terra Luna 2.0. So in today's video, we will be talking about what led to the collapse of Terra Luna in the first place, and we will also discuss what Luna 2.0 is and what they are trying to do to relaunch the project. So listen up and let's get right into it. How did Terra Luna work and what led to its collapse? In crypto, there are 4 different types of stablecoins. 1. Fiat-backed coins, which are coins that maintain reserves in fiat currencies, like the US dollar. 2. Crypto-backed coins, which are coins that are backed by stronger crypto coins, such as Bitcoin, for example. 3. Commodity-backed stablecoins, which are backed with gold, for instance. 4. Algorithmic stablecoins, which are technically backed by a series of algorithms. And Terra was an algorithmic stablecoin. In order for this coin to hold its dollar value and thus be stable, it primarily relied on another coin, which was Luna. So technically, you could have always exchanged 1 Terra for $1 worth of Luna. So both of the coins acted as a kind of shock absorber to keep the price stable. And then came the already mentioned Anchor Protocol that offered a 20% yield on invested money. This was so exciting for so many people that the total value invested in the project went from $1.1 billion in May 2021 to an astonishing $17 billion the following year in May 2022. But if you calculate the yield percentage, this means that around $3.4 billion a year needed to be paid in interest. And if you're wondering who is going to pay this much money and where would the money come from, then you'd be on the right track. Because the main reason that has led to the big collapses we have seen in crypto to date comes in the form of liquidity. By May 2022, the Anchor Protocol had around $17 billion, but the liquidity, or the trading volume, was only around 600 to 700 million per day across all of the platforms. If you are confused with those numbers, let's take an example. Let us say that there are 1 million people watching and enjoying a concert, and then suddenly someone fired a gun. Everyone panics and heads towards the door. The problem is that the exit door can only fit 2 or 3 people at a time. So imagine the chaos and the damage that would happen when a million people try to race towards that small door. And this is what happened with Terra Luna. So what freaked everyone out from the project and led them to run towards the door all at once? Well, there was an attack from someone who has noticed that the project was running low on funds to pay the huge amount of interest they had, and the attackers spent $350 million worth of UST draining the liquidity, which has ended up shrinking that exit door some more. Following this attack, all trades were frozen, and that's when people started to panic and rush towards the door. The attacker at that point spent another $650 million to sell UST on Binance. This has depegged the value from the dollar all the way down to a fraction of a penny, and everyone in their panic sold what they had, even if it was at a loss. They wanted out of that door by any means. What did that attacker gain? Well, it is at least estimated that he had made $800 million. And technically, the Terra Luna project had ended up collapsing under the weight of its own success. And when someone out there noticed the vulnerability, he took advantage and everything went crumbling down. Luna 2.0. The Terra Luna project was revived through Proposal 1623, which was voted by the project's community, out of which 65.5% agreed with it. What did this proposal entail? Well, Terraform Labs CEO Do Kwon suggested a hard fork of the Terra blockchain, and a hard fork refers to an extreme change to the protocols of a blockchain network, and it splits a cryptocurrency into two, resulting in the validation of blocks and transactions. The old chain will be renamed Terra Classic, and the new chain will be named Terra Luna. The purpose of Luna 2.0 is to create a way for the investors to bounce back from the devastating losses they've suffered from the crash, and the solution was to have a new blockchain and new crypto. With Luna 2.0, people will receive an equivalent amount of Luna just as they did before the crash took place, but the one difference is that algorithmic stablecoins will no longer be used, so no more UST. But the price of Luna 2.0 has plummeted after its launch. During the month of July, it hit an all-time low of around $3.34, and this is probably because not many people have faith in the coin anymore. It is very difficult to regain the investors' trust after such a severe crash, and additionally, Do Kwon himself is currently under investigation for fraud after the crash. Let us know if you think the Luna 2.0 can be trusted again by investors. Or will the coin just become an old remnant of its old, very successful self? Would you personally want to invest in Luna again? Share with us your thoughts in the comments down below, and don't forget to give this video a thumbs up and subscribe to the channel for more similar content such as this one. See you soon!